I would like to introduce you to Philip Streahl. He is the Chief Investment Officer of Morningstar Investments for the Americas. He joins us at the recommendation of our good friend Daniel Kemp, who you've all met before, and we're very happy to add him to our roster of people that we've spoken to. Philip has a very interesting topic. We're just take about 15 minutes today to discuss politics and the actual impact of politics on investments per the research that Philip has provided. Philip, I can also, I believe, attach that research to this video, which I'll put in the body of the YouTube video. So welcome, Philip. Thank you so much for joining us.
Thank you, Lou. Thanks for having me. Appreciate it.
Oh, it's great. Yeah, I know clients and those who watch that aren't clients really appreciate these conversations. So let's jump into it because we have agreed to keep it a brief conversation and non-political, political impact. If you could, you've studied the last 36, I believe I have that number correct, presidential elections and their impact on investments. So let's just jump right into the deep end of the pool with that. What does your research provide for investors that they should consider as part of a new administration coming in as president and the lower two chambers as well?
Absolutely, Lou. Happy to dig into some of the research we've done on the topic. And so what we've done is really try to understand, the impact of party affiliation on differences in returns you might see over a presidential term. We know that's 4 years in general, and so what we've done is we've gone back to 1881, which is the starting point of the sample. Part of the reason for that is because we're using the Shiller data set, which starts in 1871, and we need some valuation data to be able to run that analysis. So we've looked at the last 36 presidential cycles, and then looked at the how much party affiliation explains whether you're a Republican or a Democrat who's in office during that time frame, and contrasted that with a measure that we think, or a concept that we think is more important, which is valuations. We think valuations have a big impact on future returns. And so when we measure the how much of the return is explained by the party affiliation, in our analysis, that's less than 1% of the variability in returns that's explained by that. By contrast, if we look at starting valuations, and the way we're defining it in this case, it's the Shiller price to earnings ratio, which is a well-established concept in the industry. We find that that measure explains roughly 18% of the variability in returns. And so, for us, that means, yes, politics can, of course, have some impact, particularly if you drill down into particular segments, heavily regulated industries. But as a whole, if we take a long-term perspective, we think paying attention to valuations, which is the price you pay for an asset, is much more important in the long term than, which party may be in office at any given point in time.
All right, I think that's so critically important because it is common. It's okay as the advisor to receive calls. Well, I'm not for pick a party. Okay, I'm not going to name names. I'm not for this party. I want to sell everything, or I want to sell, or I want to protect, or I want to do something different. I think the research from a mathematical standpoint, using historical value rather than politics, really explains that away from the standpoint of less than 1%, as you said at the beginning, of return is correlated to whatever political party is in office. So I have to, it's anecdotal, but I think it's important. I'll go back to 2020. I get lots of calls, and I like and appreciate all of them. But I had a call from someone, and they said, sell everything because we had a Democrat coming into the presidency. So I explained, without the benefit of the Shiller data set or your research at that time, I've been through a lot of presidential elections. I would say, let's let it play out. We have pieces in place to get away from the market, all these different parts of what I do on behalf of clients. And by the way, that's specific to each client. So that's no offer of advice. But I explained to them, let's let it go for a little while. Well, now we have great conversations and the value is significantly different than it was when that call came in, and the markets are overall higher. Going back to your research, that leads to 2024. Plenty of let's say, concern with each candidate as we approach the presidential election. My question is, we've seen a real increase in the markets quickly since Trump won the presidency.
Yep.
It's natural to equate that to Trump winning the presidency. That's natural. Is it, in your professional opinion, your mathematical opinion, your research opinion, is it that we know the policy, or we can at least expect policies will be moving forward, so the market has felt some kind of relief, if you will, and not because it's Trump presidency versus Harris presidency? This would have occurred if Kamala Harris were president, because we would have known the policies if Kamala Harris were president. Am I at all on the right track with that?
Yeah, no, I think it's a great point, and I think there's a lot of things going on. Usually, one dimension is to say, look, volatility or uncertainty goes down once we know who's in the office, and think markets like less uncertainty, and so that can have a benefit. But I think more at the at the policy level, I think markets are responding. And if you look at some of the market moves, not only just the overall moves up in markets, our expectation would have been going into this election that if Trump wins, small caps, all else equal, would benefit more. Perhaps it would be more pressure on international markets, Chinese assets, et cetera, because of some of the tariff conversations. And so, I think there's real reasons why markets have, assigned, a bit of a premium, or have markets have moved up in certain areas, partly because tax policy. So we know under a Republican presidency, and also the fact that they will have both chambers in Congress, they will have an ability to potentially lower corporate taxes. And so if you just take it back to dollars and cents, we know that's generally positive for markets. But markets also tend to overreact. And if I look at some of the price moves, you look at Tesla, you look at some of those names, I think there is perhaps a sense that we of course don't know exactly what will happen. We know what was discussed on the campaign trail, if you will, and so I think there's still a lot of uncertainty in terms of whether or not they will in fact move corporate taxes from 21 to 15. I think that's yet to be seen. So markets are really great at pricing in relevant information as odds change around the elections. You even saw before, the actual results that markets, perhaps started anticipating that Trump was doing slightly better in the polls, and so. But markets also overreact, and it's still yet to be seen whether some of those policy measures can be enacted over the next couple of years, and so I'd leave it at that.
All right. Well, I think that's an excellent lead into really what Morningstar, and why Morningstar will say gets along so well with Tranquilli Financial Advisor, is because we're not in the prediction business. We're in the preparation business. And I think that's so critically important for both of us to get that point across during this conversation, because during COVID, now that's going back already 4 years, which is hard to imagine that we've been doing these video meetings beyond even before then, but talking about COVID for 4 years, it was preparation for an unknown event. Now it's preparation for whomever was going to be sitting in the Oval Office, and preparing for what those policies would be. And back to your research really focuses on the policy and how that impacts investing. So if you can, just give us a look into a piece of that. And as I mentioned, I'll put a link to your excellent paper that led me to having this conversation with you. So give us a little glimpse of how policy impacts, please, other than we'll call it the projection or the possibility of a tax decrease. What else would it impact investments?
Yeah, no, I think that's a great point, Lou, and happy to take you through kind of this concept of preparation and not outguessing. That's kind of the way he framed it in the paper. And so, when we understood, of course, that the election was around the corner, we try to go down to the position level, to the allocation level, and understand, okay, how will different types of assets respond to either election outcome? And the goal of doing that is making sure we don't think we necessarily have an advantage relative to the market in understanding whether it was going to be Trump or Harris, getting into the office. But what we want to make sure is that we're not overexposed to one particular area. And so I can highlight maybe 2 or 3 assets that we kind of thought about. And so one of them was tech stocks. And tech stocks are a great place to start just because they make up a significant portion of the U.S. market today, and just understanding what the impact on the U.S. market, on tech stock is a relevant starting point. And so when we looked at tech stocks, our view was that it was not a big enough difference in the policy proposals by either party. Both of them seemed, willing to, potentially regulate some of those big tech firms. And so our expectation was that there was not going to be really a huge difference, between a Harris or a Trump presidency. And so if you look at the market reaction, that probably is the case as well. With banks, I think it's a different story. And we have seen a pretty strong performance on the U.S. banking side on the back of the Trump presidency. And that has to do with regulation of the banking sector. And so there's been talk about maybe having more stringent capital requirements for U.S. banks. Democrats talked about that. Conversely, Republicans, Trump talked about, perhaps having less stringent regulation of banks. And so on the back of a Trump presidency, we did see financials do quite well. We also think energy, going into the election, we felt energy, and particularly midstream energy, which is a holding for us, was going to benefit under Trump, and under a Democratic office or Congress, it would have been less advantageous. And then, overseas, however, if you look at, for example, Chinese technology stocks, which is I think it's a pretty undervalued part of the market still. We felt that Trump would have a negative impact. Part of that is just because of the tariffs, and to talk about 60% across the board tariffs with Chinese technology firms. And we felt that, under a Harris presidency, those stocks would perhaps do better. And so it's really a matter of, understanding how those portfolio positions might be impacted by either election outcome, and making sure that, you're well diversified enough, and making sure that you're not overexposed in one particular area. And so one way, to sort of think about diversification is, for example, to say, if I have holdings both in Chinese technology stocks and small caps, because I know they're going to have react in an opposite way depending on who becomes
negative
president.
Correlation. Sure.
They have sort of negative correlation in that particular scenario. And so that would be a way of creating diversification in a portfolio. And so, I think that work, kind of paid off because, we think markets did respond sort of the way we thought they might, conditional on, a particular election outcome happening. So hopefully that provides some context in terms of how we tend to prepare for these types of events.
Sure. And now, because we agreed to keep this to a brief conversation today, to introduce you to everyone that watches, and we're glad to introduce you, Philip Streahl, Chief Investment Officer of the Americas for Morningstar. Now you're required to come back and have a conversation with us, let's say mid-2025, maybe even third quarter of 2025, and let's revisit this conversation, okay? I think it would be it would be a very helpful exercise to have you back on, talk more about the political impact as we see it with some data for Trump 2 as president. So it would be great to have you back if you'd join us.
Would love to.
All right. Thank you so much. A pleasure. And Philip Streahl, Chief Investment Officer, the Americas for Morningstar Investments.